In the first 3 months of this year, foreign investors pulled out over 2 lakh crore rupees out of Indian stocks. Quite the staggering exit. And in the middle of this, one institution was quietly doing the opposite. LIC, or the Life Insurance Corporation, deployed nearly $2 billion dollars into Indian equities in that same period. It bought Infosys, TCS, Bharti Airtel, Hyundai, and Maruti. All of them had fallen sharply, but LIC bought them anyway. If you are one of LIC's over 260 million policyholders, you probably did not notice this. You just paid your premium this month the way that you always do, just waiting for a policy that matures years from now. It could be around a retirement, a wedding, or an education. Basically, your money is not sitting idle with LIC. It puts it to work in the stock market on your behalf at a scale that most people do not fully comprehend. For example, the value of LIC's equity holdings has grown over 250% in 6 years to 15 lakh crore rupees. For decades, LIC has been the institution that stepped up when Indian markets wobbled, whether it was buying when foreign money was leaving the country or holding out through downturns. Fund managers have repeatedly described its style as that of a contrarian investor who buys when others are selling or vice versa. But something has been changing lately. Mutual funds fed by millions of retail investors putting money in every month through SIPs. And SIPs have grown into a sort of a second pillar of domestic market support. And LIC, which once carried Indian markets largely alone, now shares this role. Now, the shift is important because it changes what LIC is, what it's for, and who it ultimately answers to. Is it a disciplined long-term investor acting in your interest as a policyholder? Or is it the government's instrument of last resort, buying what the market will not? Whether it is a public sector bank that needs capital or a politically connected conglomerate under pressure. The answer, it turns out, is both. And that is exactly the problem. Welcome to Daybreak, a business podcast from the Ken. I'm your host Snigdha Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that's worth understanding and worth your time. Today is Tuesday, the 9th of June. So let us start with the investor, because to understand the tension in the story, you first have to see just how good LIC has been at this. The Nifty IT index, for example, is down over 27% this year. Concerns about whether India's technology companies can keep up with the AI race have hammered valuations across the board. Most investors have been cautious. But with LIC, it is a different story. During the March quarter, LIC increased its stakes in 4 of the 6 largest IT stocks in its portfolio: TCS, Infosys, LTIMindtree, and HCL Tech. This is typical LIC, you see. The pattern across the sectors is consistent. Buy on dips, stay patient through the cycles, and exit before a peak. JSW Energy is also a good example of this. In March 2020, LIC held a 5% stake in the Sajjan Jindal-led renewable energy company worth roughly 500 crore rupees. During COVID, when the power sector had a low capacity and limited investor interest, LIC kept building its position. Then, as the renewable energy theme picked up between 2023 and 2025, it started trimming. And then, when the sector corrected last year, it started buying again. The value of that holding since has risen about 13 times over the years to nearly 6,000 crore rupees. What allows LIC to invest in this way is time. Mutual fund investors tend to redeem or pause their SIPs within relatively shorter horizons. An LIC policyholder, on the other hand, typically waits 10 to 40 years for their policy to mature. That means that the company keeps collecting premiums steadily throughout market downturns and can keep deploying capital when others are pulling back. That patience also gives LIC room to shuffle within sectors. In financial services, for instance, it has held around 10% in NSE for years. Late last year, it also started buying shares in BSE, NSE's rival exchange, and now it holds close to 5.5%. Bhavin Pandey, a fund manager at MK, described LIC's position to my colleague, the Ken reporter Akriti Bhalla, in both exchanges as a bet that both players may benefit over the long term, even as they compete for the market share. Even in consumer goods, the logic holds. LIC has steadily raised its stake in Dabur, which is a stock that has been down slightly over the last 6 years, while pairing exposures to more expensive names like HUL. The bet is on value and time, but not momentum. And here is where things get a little complicated. Stay tuned to find out. LIC's contrarian style of investing and its role as a government proxy tend to look similar from the outside. Both involve buying stocks that the market is avoiding, but the reasons are different and the returns are not always the same. When SBI, for example, launched a 25,000 crore institutional placement in mid 2025, nearly a fifth of it came from LIC. Over a decade earlier, when foreign investors stayed out of an SBI fundraise, LIC provided nearly half the capital. In the case of Adani, LIC stepped in as one of the group's largest domestic institutional investors when most mutual funds kept their exposure limited. They were citing high valuations for this. And then again, some of you might remember this, a Washington Post report claimed that the government drew up a plan to use LIC to help manage the Adani Group's debt burden. The LIC later denied it. LIC's chief, R. Doraiswamy, addressed this pattern in a 2025 interview. He said each of these investments had given the company strong long-term returns. The entities may need capital, he said, but LIC also needs investment opportunities. LIC's stake in SBI, for instance, has compounded at 30% over 6 years. But here is where there is a structural problem. You see, traditional endowment plans, which are products that carry low profit margins, remain a large part of LIC's product mix. Private insurers have moved towards high margin products like term insurance. And this gap in margins is one of the reasons that the company's stock continues to trade well below where it was listed. And then there is also a shift happening at the market level. For decades, LIC was the only institution large and patient enough to absorb or sell off. Mutual funds have been growing fast. Their share of NSE listed stocks has risen from under 8% to about 11.5% in 6 years, against LIC's flat 4%. Monthly SIP inflows are now close to record highs, providing the market with a second source of domestic support. Still, LIC's structural importance has not gone away, but now it is shared. The institution that once carried Indian markets alone is now one of the two pillars. So, whether this shifts the calculus on what LIC owes the government and what it owes to its own shareholders is the question that only time can answer.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings, and a full subscription offers daily, long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.